Good afternoon, everyone. Welcome back to Short Verticals. I'm Brett Crowther. Good to be with you on this Thursday afternoon. And by the way, we have looks like a lot of people in the class already. Good to have you here. We're going to cover a lot of good stuff today. We're going to be looking at the market. We're going to be talking about our existing positions. We're going to be looking over some potential paper trades, and we'll do a lot of technical analysis in the middle of that while we look at some analysis on the stocks. We get into the Analyze tab a bit. So there's a lot to cover there. I do want to give a shout out real quick. I got Ben Watson, the Ben Watson, on the chat to help support me in this class. And thank you, Ben, for being there. He's actually coming to you live the chat via Dallas. He's out in Dallas at a workshop that's going to be tomorrow and the next day. So if you're in Dallas, swing by, go register, swing by that workshop and watch Ben. He does a phenomenal job from the stage down there. So as we get into it, though, we got to cover a couple disclosures. Give me just a moment to go through these. Do remember that options do carry a high level of risk, are not suitable for all investors. Information here is for general information purposes, not to be considered as an individualized recommendation. Paper money is for educational purposes only. All the illustrations, demonstrations we do just for educational purposes. Short options can be assigned at any time, regardless of the in or out of the money. Investing does involve risk, including loss of principal. Past performance may not guarantee or does not guarantee future results. And then also there are your option disclosures, or not disclosures, definitions. And then do note that if a stop loss is used, the stop is not guaranteed to get you out at the set price. It can change as it becomes a market order often. Okay. So with that, let's take a look at what is going on out there. Come see you. Yeah, there you go. Out of the Gaylord. If you haven't been down, that Gaylord's a pretty cool hotel too. I know I was there, gosh, not this last January, I think the January before that. It was kind of funny because it was at the Gaylord in Nashville, Tennessee, helping out with the workshop. And it was the first day they had all the Christmas decorations on. It was fantastic. In fact, we had a son and daughter-in-law that lived in Nashville. And so we spent some time with them and enjoyed walking around the Gaylord. And then later on in January, it's like January 5th or something like that, I helped at another workshop in Dallas at the Gaylord there. And it was the last day that they had all the Christmas decorations up. And so kind of caught the either end of it, but it's a fantastic place. Please join him. In fact, Ben, if you can, maybe I can go out and show it, but I'd like to, if you can, put the link to the workshop in the chat and they can jump over and register for that. Okay, all right, let's take a look at the market, though. This has been very interesting. And so, we're in this kind of situation where the market is really more about geopolitical issues, right? Like what is happening with tweets. I mean, and this isn't the first time. This happens all the time. This has happened for decades. For those of you, I mean, I've been part of, different. The company's been bought out several times. We were TD Ameritrade, then bought out by Schwab, and there's other companies before that, always bought out. And so I've been doing this since 2004, I want to say. I was like 21, 22 years I've been doing this. And I've seen so many times where sometimes the market is moving and it's just doing it based upon just your regular performance. How are the stocks doing? What are the earnings like? What are the macroeconomics like? What is the Fed doing? Just monetary and fiscal policy, all that kind of stuff. But really right now we have just more of just geopolitical issues, and that's driving a lot of what's going on in the market. And so we have to be ready for swift changes that can happen. And that's kind of a little bit rough on short verticals, but we do the best we can with it. There we go. It looks like Ben put the link in there for the workshop, and if you're in that area, go check that out. But back to this. So just note, it's not surprising that we're going to see some volatility. We see these gaps. And this can change on a dime. So just note that. But overall, we've talked about this market being predominantly up and then going sideways. It did break through a level of support. And so we are seeing some weakness, but now with this climbing again, it's just really getting topsy-turvy and unclear of exactly what it wants to do. Now, this was interesting because down here, if you look at the RSI, you can see I drew a resistance level on the RSI, and even when it rallied up on this day, let's kind of zoom in on this. So when it rallied up here, you could see the RSI was actually breaking through that resistance level, which is an indication, even though the stock had not broken through, it rallied back up to the resistance that was prior support, right here. And so when I saw that, I thought, well, wait, there's a little bit more strength on this. This is giving us a different indication. This is showing us that some bullishness has been rallying back into it, yet technically, we don't see the breakthrough. But the question is, what will it do? Will it bounce off of this and head back down or break through it? Well, that gave an indication that there's more potential. It hadn't decided yet, but potential for it to break, and that it did. Now, then, of course, this is where you get all the geopolitical stuff, and then boom, who anticipated that break? I mean, maybe we anticipated it, but we didn't know which way it would go. I don't know if you remember on that day. I know a lot of us here at work were saying, well, this could go one or two ways, right? And it could gap up or it could get down, and it gapped up. And so the move wasn't a surprise. It's just we just didn't know which direction that it was going to go. So interesting. Glad it moved the way it did, and hopefully things will continue to move in that direction. But right now we're getting back to this neutral kind of neutral stance with slight bullish bias, and a lot of the indices are actually pulling up that way. We go over the NASDAQ, we see that as well. It had a very similar situation where if we look at this right here, let's go across these tops right here, was predominantly the highs that were coming in here. And while it hadn't broken up above that, we could also see there were some highs, and maybe we do it from here, right? Maybe draw this down coming across here. And whenever I try to draw something like this, it's always a challenge to say, okay, well, where do I start? Is that the better one, or is this the better one? And really just aligning. Sometimes you'll get some that poke out of it. And the way I really look at it is, which one seems to make more sense. Now, there's an idea that you want to encompass all movement, right? And so sometimes we'll draw a line with all movement, but then the other idea is, where is most of the movement? And so the second line would incorporate most of the movement, saying, okay, well, most of the highs would hit this one, even though, we could draw one up here. Most of the highs hit the lower one that I drew. And so with that being the case, that's what, let's get out there. Come on, let go. This is what I'd leave here, watching for it to possibly break through that. And in here, it did break through that trend line. And so up, they said that there's more strength coming in, pushing this higher. And so we're seeing the NASDAQ kind of follow through. It's been a little bit of a laggard on that, though. Then you got the Dow Jones as well. And the Dow Jones really has been, this one has more of a steeper. Let's go this one right here, because that's going to connect most of those highs right there on that move. The other thing that's really interesting about the RSI is that sometimes it's not always perfect, but sometimes the 50%, just like a channel, that 50% can act as an area of support and resistance. And so if I draw a line, it's not necessarily 50%, but it's 50 on the reading there. It's midway from 0 to 100. And look at how many times it kind of comes down and bounces off that as a level of support. And so this can be used as support. It can also be resistance. I can show you times where it's been resistance, but it's something to kind of keep in mind as we're watching this move back and forth. And so a break of this area back in here was the first indication, even though this had been declining right here, we see this. Let's see, let me grab that trend line. So even though we saw price action like this, doing this number like this, right? With this here, seeing that breaking above that, it's not surprising to say at least this should hold above support, if not rally. And then after that, we can extend this out a little bit. Let's activate this line and pull it down. Now we're starting to see a little bit more of that follow through as this came up and then gave a little bit of a retest and up it went again. And so we're seeing the Dow Jones follow through. The interesting thing about that is actually looking at transports. I'm really surprised to see transports have been taking off like they do. And, a lot of times people may look at transports as kind of like the leader, because if they're moving, shipping stuff, then people are buying stuff. And so transports can be kind of a leading edge indicator. And the fact that this is doing as well it is surprising to, I think, many traders, that it's still shooting up, and it's been as strong as it has been. So there's still some bullish sentiment is what I'm getting at, that there is still, even though it's not making higher highs, higher lows, and like the overall SPX and stuff, we still see this bullish sentiment kind of lingering out there, still kind of holding the market up, I think, wanting to move up. And so we'll keep that in mind as we start looking through the stocks. I just want to check, there's been a bunch of comments coming in. And Charles, 22 years, still hope for you. Okay, just make sure I didn't want to miss anything in there. And so let me actually move over, though. We have two trades going on at the moment, one of them on CRM. If you remember on CRM, this is one where we did a bullish trade. We were looking for it to bounce off this level of support on this channel, and it was actually doing fine. It was actually moving along in here. Let's zoom in on this just a little bit, kind of get some more action. You can see. And so it was over in here that we were looking to get in as it kind of bounced off support, bounced again. And this one, it had been bouncing off of the trend line on the RSI. And so a lot of technical indicators were there. Now we were kind of pushing the envelope a little bit in the sense that overall you could say the trend was still down. It hadn't been making higher highs and higher lows, so it was kind of a little bit aggressive, right? A little bit of aggressive move. Now, it was all good. Even yesterday was fine. It was just, it was still within the range we needed. Today, however, it's Thursday. And what happens on Thursday? Well, those of you who attend my class week in, week out, pretty much know that that is when it decides to go haywire on us, right? And it just seems, now I'm throwing it all in the same, in the same basket, but it seems like so often everything's fine until Thursday, and then trades off and go against us. So this was down a little bit. Now the question is, what do we do with it? How do we manage this trade? And the question is, okay, well, what's the likelihood is it can come back up above this area, 175, by the time we get over here, which is what is that, April 24th? And what are your thoughts? Do you think it's likely? You think it's, just with the movement, and you always have to take into account how much time do we have and how far does the stock move? And so again, this is where it's not a one size fits all. And I know we want to write it down and put it in a nice little package and wrap it up with a bow and say, here are the rules for this trade. But, like if it goes $8, it's too far, type stuff. But it depends. If the stock is, well, how far is this one below it? Was that 175? We're down 169. So we're $6 out, right? $6 out. If we have 3 weeks, can it recoup $6? If it were to bounce somewhere in here, could it conceivably come back within this box, this range in that time frame? Well, if we just kind of look at the range, I could throw an average true range on here, but we just look right here, the R, and if I move this along, that was an $11 day. This is a $4.5, $5, $6 day. The stock moves $6, $7 a day on average. So in an average move, it could come right back up, right? So in this case, there's obviously plenty of room, plenty of time for it to make its move. Now, if I were to look at this and say, okay, this moves like 28 cents a day on average. Okay, now a $6 move is huge. You see, so it kind of varies depending on what's the volatility of the stock, what's the average movement. And this one, plenty of time. So we'll just sit there and recoup a little bit and come back up. If not, then we'll look to exit that trade. The other one, APH. Now on this one, that's not the one we had. Was it APH? Oh, you know what? Actually, let me say something about this. CRM was the one where we did the iron condor. Remember that? I put it on here. So we have a bear call vertical here, and we have a bull put vertical here. And so the bear call vertical is doing very well. It's the bull put vertical that's not doing so well. And I just want to, in fact, let me take it over to the monitor tab and I'll show you this. I'm going to monitor this position, go to CRM. And so this position right here, let's see, which is the call, which is the put. Here we go. So here's the put side. So put side is the one that's getting squeezed, right? So that one, that's where we're losing $200 between those. So we're losing 600 on this leg and we're making 400 on that leg. So we're down 200 there. But if we look on the other side, these two, we're making the 200. We're making 200 on the short leg, but we're losing 180 or 120 on the long leg. So we're making $80 on that side. And so the call side is doing well. It's the put side that's not doing so well. And so this is also playing into a role where what we could possibly do is if we think it's going to bounce, in fact, let's go ahead and do this. Let's go ahead and do this. I think this is a valuable lesson. Like, now this has not gained all the value, but I want to walk through and just kind of explain this. Like, ideally we look for this to come down and lose more value, right, than it has. But you know what? I'm going to go ahead and do this. Create closing order. We're just going to create this. Oh, 9 cents. Actually, that's I thought it had more value than that. Actually, most of that leg is gone. There's not very much left of it. So whatever we sold on that leg that value is basically dwindled down to very little. So let's go ahead and confirm and send that off and buy that back. And so now what happened is I'll have to go back and look and see what exactly was the value that we got in that short leg four, that short side four on the calls. But now we have that is helping it would help buffer the dip, right? So now if this comes back up, we're not going to lose on that call side, and that will just help out on that position. So we'll watch that one. Let's see. Comments in here. I took small profit on CRM. Okay. Just put bearish trade on this one as well. Okay. All right. Comment on strength or move of the markets because only a short ceasefire comment. Let me just make sure I understand this. Comment on the strength of move on markets because of only a short ceasefire comment. I'm not sure I quite get that, but yeah, my point was, and I think it's what you're hitting at, is that the market is moving, yes, but it is just for now, right? And this can change, and that's what I was saying is things can alter quickly, very quickly. All right, APH was the other one, and APH was a bearish trade, and it popped up. So, and once again, we have time on this one. It's not very far out there. Now, this one doesn't move quite as quick as we look at this. The range on this one is $4 and $5 and $2 and $3. So, about $3 roughly. But we're talking about we need to be below 130, and it's sitting up here about what, 137-ish, 137 and a half. So still obviously time for this to come back down. There's even, I don't know if we have some resistance across here, do we? I'm just going to incorporate most. There's not some good lines. I'd like to draw some lines across here, but there's not really any good lines to draw, even if I come from the top up here. Maybe we could say it broke out of that, which is a little bit concerning. So didn't bounce off the 50. They're showing a little bit of life. So this is APH. So we had a bear call on this one that we did last week. So we sold the 130, we bought the 135. And just watch it. We need that one to be below the 130 expiration. So I'm going to watch that one, even if I just get a little bit of a pullback. If it's the fact that we're seeing some weakness on that, at least from the bearish perspective, meaning it's getting some bullishness, may look to close that out if it's not quite pulling back down. But I'll watch that over this next week, see if we get a little bit of retracement, see if where it goes. But if it kind of drifts around and starts to kind of drift higher, we'll go ahead and close it. Okay. So yeah, that's Charles. Hopefully that helps you out. Yeah, it's a 130, 135 bear call spread. Sold the 130, bought the 135, looking for it to be below 130. Now we have this one going out, I want to say till May, but there is this earnings, and this is something that's being an issue that's coming up, is we have earnings season coming up, which is going to make it a little bit of a challenge to find, some trades at times. That can be a challenge. And so sometimes you just got to wait for some to pass by. Sometimes, we can get in like this one and play it before we get there. And a lot of times there's still some possibilities. In fact, we can look through some stocks and see what's out there and what opportunities present themselves. In fact, one of them that I was looking at a little bit earlier was at MRK. This one, now look at this. So we have earnings coming up on this one. This is what, on the 30th. All right. So here's a situation where the earnings isn't necessarily around the corner. We still have 20 plus days till earnings. We don't necessarily want to hold this right up to earnings, but there are some opportunities. You see a bullish play. There might be some opportunity to play this between now and up to earnings. Obviously, we want to be out before earnings. Let's look at the trade tab and let's just see what that allows in here, because there's a couple different things I want to talk about with this. And so, earnings is coming out on what did we say, the 30th? And so we're talking about 21 days. And so right about here in May is when that earnings is coming out. And one thing to be careful of is actually we may think, well, here, let's possibly look at the May strikes. We could go with that, right? If we're looking to make a play on this, it's May 1st is real close to the 30th, right? But what's the challenge in that? What is the challenge in that? Well, one of the challenges is, and it doesn't really show it very well on this option chain. I think there's some others that maybe, let me show you another one. I'm going to come back to this. Hang tight with me on this thought as we talk about earnings and option strike selection, okay? I'm going to pull up another one that maybe is a little bit closer, like maybe is this one closer? The 15th. And so this one is in 6 days, right? And so I'd actually like one that's tomorrow, but check this out. So if we go over to the trade tab here and we just look at the implied volatility on here, when does that one happen? Well, it happens on the 15th. And so here's the 17th. This is the expiration cycle that encompasses that earnings announcement. And look at the implied volatility. So we got 33, we got 39, 34, 33, and so forth, right? And so that's the highest one. The highest one is the one that's right next to that earnings announcement, which is not surprising. It's oftentimes it can be where, you know, the implied volatility will build up going into that earnings announcement. And so, you know, if we're looking to select a strike, we may want to avoid one that is the expiration coincides pretty close with the earnings announcement, because what's going to happen there is either it's going to ramp up, and if we decide to get out early, well, those are ramping up because those that are in those options don't have time to wait, right? And so now we have to make that decision on something that's ramping up, or if it's not, it makes it hard for us to, like, if it's looking good and maybe it expires right before it, it can still have some high earning or some high implied volatility going right up to it. And they may not melt off as quickly as we'd like them to. And so sometimes it's good just to either decide to go, you know, enough early, like a week or so early, that we're not dealing with that, or even just a little bit longer and just get out. You know, we don't have to hold it all that time, even though it's nice to get that time decay, that very last bit, that's ideal. But we're not dealing with an ideal world, right? Sometimes we have earnings announcements coming up, and it happens 4 times a year where we have, you know, earnings season. So the question is, you know, how do we work around it? And part of that is, well, we still want to trade these. This is one way to work around it. Okay, let me just make sure. I'm seeing some questions come in. Which factors do you consider to decide either long vertical or short put vertical on a trade? Quite honestly, Charles, they're almost, if you're picking the same strikes, they're very, very, very similar. If you're picking the same strikes, you know, you're still like on a put and a call you're selling, you know, like I should say, the legs that you pick are the same. You know, it's just obviously one's a credit, one's a debit because you're flipping them. It's going to be extremely close. It's going to be extremely close. And so there's not as much difference as people think. A lot of times people that I hear talk about it, they like the credit aspect because then, you know, if it drops down, then they can simply let it expire, or it just feels like they like the idea of money coming in instead of putting money on the line, right, and collecting it later. But honestly, there's not a lot of difference between them. Just one thing to consider is, depending on the situation, sometimes the calls, like maybe you're looking at being bullish, and if implied volatility might stick up there, then sometimes a long call vertical could work over a short put vertical, because the implied volatility tends to be a little stickier on the put side, and so it's not going to drop down in value as much. And if it increases, then it can help you more on that long call vertical. Good question. Good question. But quite honestly, the big overall arching thing is primarily they're extremely similar. And that's the thing most people don't realize. They think they're, you know, they're different trades, and they are, but they're more similar, way more similar than they are different. Okay. One difference is that the early assignment threatens. Okay. Well, it can, but remember on each leg you have a short and a long, right? So it depends on where you place them. And do remember, yeah, if it is in the money, you know, if you're in the money, you're getting closer, as kind of Ben was noting here, you can get assigned as you get closer to expiration. All right, so let's look at this. Let's go back here. I was mentioning there are things that we can do like Merck. Let's go back to Merck. You know, so Merck overall uptrend, you know, came down, bounced off support. It actually does a fairly good job using, this is a 50 period moving average. I'm going to change that. I'm going to edit that. And a 30, I'm going to try a 30. You'll see it does tend to bounce off this 30. It's a little bit more sideways right here. We kind of have a channel that it's almost going in between, but this could get a bounce off that heading on up. Let's see if we can make something work down here at support around 118. Let's just see what it does for us, okay? Now what I'm going to do is I'm going to go out, instead of doing, I could either do the April 24, which is only 15 days. And so that might be a little bit tight to get anything out of. Let's just see if we're looking for it to be above 118. Yeah, I might need a few more strikes in here. Let's do 18 strikes. So if we sell the 118 and maybe buy the 116, we're getting 28 cents credit. So see, there's not a lot in there, right? 30. So if we had, let's just leave it at 30. If we had 30 cents credit on a 2-wide strike, that means there's, well, $2. You know, we sell, and the idea behind this, for those who may be a little bit more new to this, is the idea is we're selling the 118 put, we're bringing in the credit there. But if the stock, goes down, then we'll get put the stock at 118. Well, to protect ourselves, we're buying the 116 put. And so basically we'd have to buy it at 118, but we could sell it to someone else at 116. So the most we'd lose on that is $2. But we brought in a credit for selling the 118, and we took some of that credit to buy the 116, and the net difference is the 30 cents. And so if we keep that 30 cents, that means really the risk on that is $1.70. The $2 loss here, but keep the 30 cents, so that's $1.70. And so that's not a very good return to risk. So that one doesn't quite play out. But let's see if we go out a little bit more. Go out a little bit more. We're going to skip over that one. We're going to come out here to the May. And in May, let's see if we can sell the 118 and go down to the 116. And it's interesting here. Remember, we're getting 28, 29. I bumped up to 30 just to lock it in. Already there's a little bit more credit on that. And so this, you can see that sometimes it can offer you a bit more. And if we can hold it over a similar time frame, now the other one would probably drop down to 0, obviously a little faster, but also there's just not much in there. So if it goes wrong, then it's going to leave us a little bit more on the hook, right? Where this one, we could possibly pull in 45 cents. So again, we're selling the 118. Using some of that premium that comes in, that $1.73, we're going to use some of that premium to buy the 116. And the difference is, we're getting the mid between these. And so it's going to be the 45 cents. Now, $2 of risk minus the 45 cents is going to be, what is that, $1.55? Yeah, $1.55. And $1.55, let's see, now hold on. I'm going to do 45 cents. I mean, this is almost going to be 30%, isn't it? 45 cents divided by $1.55. So this is our reward of 45 cents divided by our risk to get a risk reward ratio is 29%, about 30%. And typically speaking, I like to see something on around that 30 to 40%. The thing that's interesting about this one is the delta on this is only a 28. That's actually kind of a low delta, to get about 30%. Just if you run the numbers enough, you start to see where, if you look for a 30 to 40 delta, a lot of times the risk reward, if it's playing out right, will often be very similar. Meaning you look for a 30%, 32% return on risk, and then the delta will be somewhere around a 32 as well, right? So they kind of match up. If they get really out of whack, then something's wrong. Meaning, if your return on risk percentage comes out to be like a 0.25 and your delta is a 0.37, then you're not getting a very good return for the risk you're taking, because obviously the higher the delta, it's indicating a higher likelihood that position will be threatened. And so usually when it's like this, it's coming in pretty close to one another. That's what I'm looking for. And so this actually isn't too bad. This actually isn't too bad. We can even bump that up. Maybe even go, if we want to get a little more aggressive on that, go 119. Let's just try this. Let's try the 119, 117. Let's open that up. Let's see. Oops, what am I missing here? Wow. It's not nearly as good. 21 cent. That is crazy. I didn't think it'd jump like that. Let's go back to 118, 116. Did that change on us? It changed something? Let's see. Oh, there it goes. I unlocked it. I thought I unlocked it before too. Let me just recreate that one. 119, click on that, and I'm going to hold down the control key, come over, click on Click on the 117. There we go, 42 cents. And so here's an interesting thing. And so, we're at 42.43, but we're going $1 higher. It's interesting. It seems like, well, let's go lower, and we're getting essentially the same amount, if not more. That's actually a better deal on that one. So let's go ahead and run with this one here. And I'm going to lock that in at 45 cents so we can run our numbers. So if we're receiving a 45-cent credit, which is, and a risk on that, as we mentioned, is a $1.55, and we risk $1,000 per trade. Well, $1,000 divided by the risk on the trade of $1.55 is going to tell us that we can get into 6 contracts. And so I'm going to move this down to 6 contracts and check that out. Now with this, I'm going to go ahead and right click on this. I'm going to hit Analyze Trade. So I think it's just good for everyone to be familiar with this Analyze tab. And this just shows us our risk reward graph of what's happening. So what this is saying is this is at expiration, so we got 523. We're not going to hold it all the way till expiration, but this is just saying, okay, what's the probability? Well, the probability of the movement of the stock is, with 1 standard deviation, it can come down to 230 and go all the way up to whatever that is, like 305. So that's the expected move of the stock, and that's good to keep in mind, because the stock will sometimes go up and sometimes comes down, and if we're not really anticipating that move, it can throw us for a loop. But just knowing that's kind of the standard window that the stock should move is between this area over the next couple weeks till expiration, then it helps kind of calm our nerves and help us understand, okay, it's moving, it's okay. One thing we can do with this is, if we want to move this, this is saying, by the way, here's our profit loss, and so as the stock goes down, we're losing money. And that's where we hit max loss right there, is right here. That's max loss, and right up here is max gain, because after that we're not making any more money, and then somewhere in between here is our gain loss. And so we can even move this. We could drag this probability over here and say, well, what's the probability of max gain? Well, we got 38% probability of max gain. And what's the probability of some gain? Well, some gain is about 60% probability of some gain on that trade. So it's kind of a fun thing to play around with this. It's good just to be familiar with it. You're going to see a lot of people talk about, the risk reward graph. And so it's always nice to be familiar with this. Any questions on this, by the way? Let's see. Am I in the wrong stock? Oh, this is the wrong stock. Did that not transfer over? What happened? Thank you. Why did that go? Oh, this one isn't locked. I thought I had that locked. Thank you. All right, here we go. The one that was in there happened to be the same trade. That's crazy. Having to work out. All right. So what I'm going to do is, you'll see there's these additional lines. What I'm going to do is, I'm going to come down here to the slices. I'm going to go to break even and select that break even time. And here we go. Okay. So on break even, 70% probability. I was thinking that 60 was a little bit low, but I was wondering what was going on there. 70% probability of being above that. 30% probability of being below that. As we noted, it's going to follow that delta very similar manner of, probability of making some money on this, about 75%. Probability of making all the money, if I move it up to this spot right here, is 67.5%. Yeah, it happens. Ben knows that'll happen from time to time, where they get unlinked. So, and again, there's your window between here all the way down to 112.71 and all the way up to 133.63 would be the range the stock could potentially move on. And this is kind of the nice thing, is we're looking for, price action to be right here. We're looking for it to be basically in this area, right? Somewhere up in here versus, somewhere down in here. And if you look at the expected move, it's expected to be more in this ballpark, which is exactly what we want for that trade. And so we're good there. Let me go ahead and remove all this and come back to our trade tab, and we're going to go ahead and send that off. So I'm going to hit confirm and send send that off. We're good. Just making sure there's no warnings, no anything I'm missing. Send it off, and there we go. Good to go. All right. Let me just check, make sure I didn't miss any items on this. Okay. Got it. All right. All right, let's go back out to the charts. We're gonna look through a couple more. I brought up Coca-Cola last time, saying, this is one that's bouncing. I think we're starting to get a little bit close to that earnings. It's a couple days earlier than when we just did. MO was another one. Altria, when's that earnings announcement? That's on 4:30. Might be something in there. You can see it's kind of coming down, bouncing off of this Fibonacci, and then rallying back up from there. And so there might be something on that. Let me also look at AMAT. These are some that we've talked about. We've looked at. Oh, this is interesting. I actually want to cover something very important I've seen in this one. And by the way, some of these stocks I'll cover and I'll keep an eye on on my X feed. And so go out to X, follow me and Ben Watson. You know, Ben, his X feed is Ben Watson CS. You know, so at Ben Watson CS, and you can see mine is at Brett Crowther CS. But you know, I do post things like, you know, I posted stuff like this is talking about unemployment and the duration of unemployment for different categories. It's like most of the unemployment, about 30% was less than 5 weeks, which indicates there's some that are just in transition, right? Out of one job, transitioning to another job. You know, I talked about Palo Alto having a cup and handle pattern. Seagate Technology possibly, you know, started to break out of a channel, stuff like that. And so, you know, I'll bring these things up throughout the week. Oil crashed hard, right? The other day. Wow. Oil came down pretty hard. And so it's just a way for me to keep in touch and talk about things in between us meeting every Thursday, right? It gives us an opportunity to touch base. But one of the things I wanted to address on this, I've seen this from time to time, and I thought, oh, here, let's look at this symmetrical triangle that was forming. It popped out. Now, the challenge on this one is we don't have an earnings announcement coming up, and so that's a good thing. However, the challenge with this is kind of run a bit from support. I mean, we're all the way up here at like almost 400, and the last support level from the diagonal is down here about 360 or so. So you'll possibly wait for a pullback, a bounce off that and a rally. Now, one of the things I want to address is that, you know, when we're looking at these symmetrical triangles, the question is, okay, well, how far should it go on the breakout? Well, they always say the widest point of the triangle. Well, where's the widest point? You know, is the widest point, you know, here? Is that the widest point? Because that's where we got the two touches. Or is it, you know, should I expand this out? Extend to the left. Should I expand that out and say this is the widest point? You know, and sometimes I've seen it where stocks make a big move, like they come down and they make a big old move and then they do this, right? And then if you were to draw the triangle on that one, it'd be something like this, you know, like this type of a thing, right? And they say, okay, the widest point. You're like, well, the widest point is way out here, and so you're like, that's not really indicative of what typically it moves. And so I want to be careful about just saying take the widest point as just the go-to. So one way to look at this is start counting them off. You know, like this is where it starts. So there's the first touch, second touch, third touch, fourth touch. And you need 4 because you need 2 touches on the top and 2 touches on the bottom just to draw a line, right? You need that just to connect the dots. And so while some people will take the 1, others will take the 2. I think I look at it as the 2 is the more conservative one and the 1 is the more aggressive one, if that makes sense. You know, so the distance right here on the 1 is a little bit more aggressive because now you're kind of projecting out there a little bit more, where at least the 2 is where we've had some touches that have been hit on both sides at that point. So I look for the 2, take that, duplicate that one, pull that out, and wherever this bounces. And so if this bounce comes back and bounces somewhere here in the future, that's where we'll add that 2 to say, okay, where's a projected target up above? And so something to keep an eye on as we're watching for that one to possibly pull back and bounce. All right. I don't know if I'm going to have time or if there's another one out there. PNW is hoping would that was the one with the cup and handle. And this one is interesting as well because it formed this cup kind of like this. And then this is the handle. This is a little bit deeper handle. Usually the handle is kind of small. And it was trying to break out above this level right here, right there, right? And so you can see this is an attempt, and it had a good attempt. And yesterday it really looked like it was going to do it, but then it couldn't. It came back down. We got kind of a shooting star candlestick formation, and then today kind of a confirmation of that pulling back down. Now, what is the overall trend or thought on this one? You know, this is actually getting bullish. even though it doesn't seem like that, with a huge red candle today. But let me point out some things that will help build this case for this one potentially being bullish and watching for some sort of a bounce, maybe off of a support level, even a diagonal or something like that. In fact, let's draw in a diagonal support level on this one. Oh, come on, I'm gonna draw. There we go. Here, it could bounce in there, somewhere in there. But look at this. Like if we come down here, looking at the RSI, this one has been building pressure. This is where it hit its bottom right here back in February, and it's dropped lower, but it's been building pressure, higher low, higher low. That's been building pressure. Well, it had a lower low and now making a higher low. And so you can see it actually is building higher pressure, and this is now making a higher high coming out of there. So while this is shooting back down, there's a potential for this one to bounce. So let's keep an eye on that and see if that can bounce between now and next week. And it could potentially give us an opportunity for a bull put spread, or, you know, for this class or even other long positions from other classes, depending on what we like to trade. Okay. But let's see. Any questions? Anything I missed? Let me just check. Just see. By the way, like and subscribe. Yeah, thank you, Ben, for saying like and subscribe. Hey, you get a chance, please hit that like and subscribe. It just helps let the company know that you enjoy these webcasts and that we can help continue to create more of these educational offerings for you. So please do that. Yeah, okay, Pan, JB talked about that tilting up. I guess we're on the same page. I haven't talked to JB about it, but I guess we're on the same page on this one. Let's see. It looks like I got them all in there. All right. Well, so just a couple to look at then, a couple to keep in mind. We'll keep an eye on the ones that we still have going, the ones we added. STX was the other one I was mentioning on my X feed. That one broke out, possibly look for a retracement. Again, sometimes when the gap like that, they kind of get away for a vertical spread, just because, you know, by the time we want to put where we're selling it at support, it's so far away, the credit is just so small. So sometimes we got to wait for a little bit of a retracement to get in those. And so a couple to look at. So we'll keep an eye on those. Again, if you're down in Dallas, you know, swing by, check out the workshop with Ben, say hi to him. Mike Fairborn coming up next with ThinkScript. Join him. Covers a lot of good stuff. I'm going to be out of here. I'm actually heading tomorrow. I'll be off. I'm going to head to Yellowstone National Park. So just real quick, kind of a fun thing is if you're a cyclist like I am, and a bunch of my friends, my wife is, we're going to go to Yellowstone, and there's a 2-week window before the park opens. They allow cyclists on the road, but not cars. And so it's a great way to explore Yellowstone if you ever get the chance. So we're going to go from West Yellowstone about 50, 60 miles up to Gardner, Montana, on the north end of Yellowstone, spend the night, and then ride back the next day. So it's a fun ride. I'll see if I can post some pictures of that one as well. But hope all that goes well, and I hope you have a good week as well. And we'll see you back next week as we cover more short verticals. We'll see you then.